This is the 19th installment to the series Build Your Business into an Asset of Value. Diversification is the only free lunch in investing. As an entrepreneur aspiring to build a business into an asset of value, you must understand how prospective investors will decide on how much they will be willing to pay for an ownership stake in your business. In the following chapters, I introduce the different methods investors use to calculate the value of a business, together with the factors that influence their decision. In this chapter, I address the relationship between risk and return from an investor's perspective. Investors are spoilt for choice when it comes to prospective investment opportunities. A basic principle of investing is that a positive relationship exists between investment risk and return. In simple language, it means that when accepting a high level of investment risk, investors demand a high investment return. The investor's expectation of an investment return is the basis on which the investor calculates the value of a prospective investment opportunity. In other words, the price the investor is willing to pay for an investment opportunity today is informed by their expectation of the potential profit of realizing their investment opportunity in the future. Investors may choose to invest capital in a variety of asset classes, of which private equity and ownership stake in a private company is but one option. In fact, savvy investors understand that diversification, spreading investment risk amongst different asset classes, is a cornerstone investment principle. Every investor has a unique perspective on risk, but for the purpose of this book, consider 3 investment risk profiles: conservative, moderate, and aggressive risk profiles. The proportional spread of capital amongst different asset classes reflects the risk profile of the investor, as can be seen in the following illustrations. A conservative risk profile will mainly consist of low-risk asset classes such as cash and government bonds. A moderate risk profile will include a limited exposure to property and equities. And an aggressive risk profile will invest mainly in public and private equity. Understanding asset classes. The main asset classes include cash, money on hand or cash in the bank. Cash is generally accepted as the asset class with the lowest risk, but cash almost never yield an inflation-beating return. Consequently, investors must diversify into other assets and asset classes to ensure a real return on investment. Government bonds. Governments borrow money from investors by issuing bonds. A bond issued by a respected government in hard currency, like the US dollar, is generally accepted as a low-risk investment option. In contrast, a bond issued by the government of a third world country with a weak currency is regarded as higher risk. The result is that governments of third world countries must offer a higher rate of return to attract international investors. At the time of writing this book, a 10-year government bond issued by the US government offered investors a yield of approximately 4% per annum, whereas a 10-year government bond issued by the South African government offered investors a yield of approximately 9.5% per annum. Corporate bonds. Large businesses, often called blue-chip companies, listed on a stock or bond exchange, can also issue bonds. The performance and reputation of the issuer informs the investor's perception of risk. Corporate bonds typically offer a higher yield than government bonds. Junk bonds. Smaller businesses listed on a stock or bond exchange can also issue bonds, but investors typically associate more risk with these issuers. The higher yields offered by junk bonds reflect the perception of higher risk. Property. Property as an asset class have many subclasses, including commercial, industrial, retail, and residential property. In very general terms, property is seen as less risky since properties typically appreciate and often include a yield in the form of rental income from tenants. Public equity. Companies go public or list, often referred to as an initial public offering or IPO, on a stock exchange like the Johannesburg Stock Exchange to raise capital from investors. Investors buy, that is invest, and sell, to divest, stock in these listed entities by utilizing the services of a stock broker. Large cap listed entities, big businesses, are typically seen as less risky than small to medium cap listed entities, smaller businesses. Listed entities spend a lot of effort and money to remain compliant with the regulatory requirements imposed on them by the stock exchange. But this benefits investors since the financial statements of publicly listed entities must be made available to the public. Many other regulations apply to protect investors. Investors also find it much easier to sell, to divest from a listed entity, since most of these companies are regularly traded by many stock brokers. Private equity. Private companies owned by individuals or other entities. The financial information of private companies is private, not made available to the public. Also, the reporting standards applicable to private companies are of a lower order. It is much more difficult for investors to access reliable information about private businesses. Since no formal market exists to trade in the stock of a private company, it is also much harder to buy or sell an ownership stake in a private business. Private equity and ownership stake in a private company lies on the highest end of the risk versus reward continuum of asset classes. An investor's expectation. The expected rate of return reflects the perceived level of risk. To get a more precise handle on the rate of return that investors in private equity will deem acceptable, we need an anchor. A useful starting point is to consider the risk-free rate of return. Sovereign risk, the risk that a government defaults on its debt obligations, that is, government bonds, and best represented by a 10-year government bond, is commonly regarded as the best measure of a risk-free rate of return. A 10-year government bond is the closest thing an investor can get to a sure thing. If the yield on a 10-year government bond issued by the South African government amounts to 9.5% per annum, then it follows that the other asset classes must offer investors an increasingly higher rate of return in line with the increased level of risk. It is therefore reasonable for an investor to expect a rate of return exceeding 20% per annum for taking on the higher risk associated with an investment in private equity. In conclusion, a business owner seeking to attract investors are in a competition for capital and must be able to present a convincing case to investors seeking a high rate of return. But there are many other factors that influence the perception of investors seeking an ownership stake in a private company. Thank you for watching. To access the full series, visit Constructum Online Learning on YouTube or click on the link in the post.